Well, for more on what to expect out of this earnings season, I want to bring in Doug Sandler. He's the co-founder and chief equity officer at Riverfront Investment Group. John and Dom with me as well. Doug, good to see you again.
Thank you. Good to be here.
Well, okay, so first off, what is this earnings season going to tell you?
Well, I think the earnings season is always a bit of a dividing rod to separate which companies are able to deliver on promises and which ones aren't. In the end, I think we don't want to make the market too complicated here. I think you're seeing unprecedented stimulus. You have a recovering economy, and you have stocks that are reasonably valued. So, I would guess that unless you see a real disaster on the earnings front, and that always could happen on a company-specific basis, this is going to be a decent earnings season where I think people were probably too skeptical coming into it, and they're going to leave relieved.
But what's the chance that you're going to see companies use oil or rising commodity prices as an excuse for poor performance?
Certainly for the companies that don't meet expectations, that would be a very convenient excuse, and you'd expect to see it used. On the other hand, it's a well-known story. You've seen companies already, those that are really affected, provide some guidance there. But I don't think it's going to be a surprise to investors, and higher commodity prices, if that's really the reason why a company misses earnings, I think investors will be willing to write that off.
Doug, it's John Erlichman. Last time I checked, the market's been on a pretty strong run. So when you say skepticism, what are you talking about? What sectors are you saying people just felt bearish ahead of this earnings season about?
Well, I think skepticism is different than pessimism. A year and a half ago, you would have said everybody was pessimistic. We're far from optimistic, and I think when you ask the average investor, what they think of the market, they're quick to tell you what could go wrong. They're quick to point out the stuff going on in the Middle East and Japan, higher commodity prices. Not many people looking at what could go right. I would remind people that we've gone really through 10 years in the wilderness for equities where you've really had no returns. Valuations maybe aren't screaming cheap, but on a relative basis versus alternative places to put your money, there's really few things better than U.S. equities.
Hey, Doug, how far does that zero interest rate environment picture get you for demand? We're a broken record. We talk about no volumes all the time on this show throughout our broadcasts here. What gets people in the market here? I mean, if the market just keeps on grinding higher, is there something that scares people to say, hey, I'm missing the train, I got to get in?
I think ultimately, investors go on fear and fear and greed. So I think, what you haven't had the last 2 years is you haven't had a real punishment for people who own bonds. And, they could look at their neighbors and they could say, well, they're up 30% in stocks, but hey, I'm up 30% in my bond portfolio, so I feel pretty good too. I think what changes it is when all of a sudden you get the pain of being in bonds and you see your neighbors who are in equities doing a lot better. And that ultimately what gets people to change asset classes. And you're starting to see it a tiny bit, but we're in the first couple pitches of a 9-inning baseball game, and I think we have a long way to go.
Well, we mentioned at the top of the show, Bill Gross getting concerned about what's going to happen to bonds when the government stops buying them anymore, and that's why he's holding a lot of cash in his big $236 billion.
Being short in technically weighs a lot of Treasury exposure.
So I'm sensing a little bit of Monday blues.
Yeah.
Doug, what gets you excited?
Well, there's a lot that gets us excited. I think, to use the baseball analogy again, we're probably in the middle innings of the economic recovery, middle innings of the stock bull market, which means you want to use middle inning strategies in your equity investing. And for us, that means all about kind of GARP, the growth at a reasonable price. They're going to be good companies. And trying to find those and not necessarily make a cyclical trade or a defensive trade, just find the good companies at good prices. So a couple we've recently added to our portfolios. So these are ones that we own and I own personally. A name would be like Moody's Corp, which is a financial company. They do bond ratings.
Yeah,
very stable business. Yeah, very stable business because it's fee-based. And basically all you're betting on is whether there's going to be more bond issuance across the world, and if so, Moody's will be a beneficiary of that. Here's a company that has been cheap. It's cheap because of all the things that happened in the credit crisis where Moody's had its name a bit tarred, maybe deservedly.
Right. Yeah.
But here they are coming out of it, and they still have a wonderful franchise. And if you can see them getting through kind of all the problems of the credit crisis with the franchise where they still have leading market share, I'd have to say it's pretty unassailable.
I mean, they essentially have a duopoly with S&P. Doug, thank you. Doug Sandler, the co-founder, chief equity officer of Riverfront Investment Group.